ETFs versus stocks for an almost forever portfolio. Hi, I'm Doug Weiss, and this is Wise Investing. So I wanted to do an experiment. I wanted to look back and compare owning 5 exchange-traded funds with owning 10 stocks and see which would have better performance, where I would be rebalancing each portfolio every year. So first, for my exchange-traded funds, I'm using 5 Vanguard funds. The funds that I've used are the Vanguard Energy, VDE, the Vanguard Healthcare, VHT, Vanguard Emerging Market, VWO, Vanguard Real Estate, VNQ, and the VGT, which is the Vanguard Information Technology. I found that these 5 funds, because they don't always have the same performance each year, were ideal when you're rebalancing annually. Remember, when you rebalance annually, what you're doing is you're making sure that your 20% position in each of these 5 stays the same once a year. So if during the course of the year, the Vanguard Information Technology Fund did really well, maybe 40 or 50%, at the end of the year, you would be selling a portion of that fund and then adding it to the other 4 funds. That way, you're basically buying low and selling high. I wanted to compare that to a portfolio of 10 stocks. The 10 names that were in the Raymond James article, the 10 picks were Bank of America, Consol Energy, Digital Realty Trust, Equinix, Halliburton, NVIDIA, Lincoln National, Panera Bread, Pioneer Natural Resources, and Stanley Black & Decker. And as I said, we're going to purchase $100, 10% of each of these stocks, and then the only caveat is this portfolio every December 31st automatically rebalances to maintain that 10% position in each of the stocks. So again, we're going to compare the S&P 500 buy and hold to my 5 ETF rebalancing annually and the 10 stock Raymond James pick from 2011, 10% into each of those rebalancing annually. And so here were the results. The 5 exchange-traded fund portfolio, $1,000, grew to $3,600 in December of 2023. The S&P 500, just buy and hold the S&P 500 for that period of time from 2012 to 2023, you would have $4,800. The results of the 10 stock portfolio were pretty impressive. It had a value of $6,300 by the end of 2023. I was very interested in why was there such great outperformance in that 10 stock portfolio. I mean, one of the names, NVIDIA, that has to be a big reason, right? We know over that period of time, NVIDIA just had a phenomenal return. But remember, we're only maintaining a 10% position in that portfolio in each stock. So even if NVIDIA had a great year, any of those years, you're still selling a big portion of that and dividing it into the other stocks. Well, it turns out when you have stocks that outperform each other in any given year, so if you have one year where certain stocks go down 20, 30%, and that same year other stocks go up 30%, that's a big factor in why the annual rebalancing works. In fact, that's why that portfolio outperformed the other 2, because there's a much bigger discrepancy when you're talking about stocks versus ETFs. ETFs, because they already have so many stocks in them, their ups and downs just aren't as great. So when you rebalance, the effect of the rebalancing isn't as effective as when you rebalance an all-stock portfolio. So I found these results very interesting and very encouraging. Now, I'm not going to say that these are the best 10 stocks to own going forward. In fact, in some other videos, I'm going to explore that question. But I think what this shows is the power of having 10 picks and holding them over a period of 10 years. To be honest, even just getting the same return as the S&P is much better than the average investor. The studies that I've done over 10-year periods where the stock market returns 10%, the average real investor only makes about 4% because of all of the pitfalls that investors unfortunately have to experience. I hope this has been helpful. If you want to see more videos like this, please subscribe to my channel.